Welcome back to the next iteration of the Maslow Wealth Barside Chat. As you know, my name is Matthew Jakimiak, and I'm the Chief Investment Officer here. And I've got with me Isaac Thompson, who is my portfolio manager, and I'm also excited to say one of the newest partners at the firm. Welcome. How are we doing?
We're doing great. We're doing
Awesome.
great. Yeah. Well, Matt, let's jump right into it. Direct lending back in the news again. Today we're talking about AI and software. What are you hearing about, AI and private credit?
Yeah, private credit, direct lending, it kind of feels like it's the gift that keeps on giving if you're a Wall Street Journal reporter. And so let's kind of give people a context of what's going on, and I'll give some other macro picture, and then we'll jump into the micro. But from a macro perspective, what's happening is first, there's kind of this flurry of stories and fear about how AI is ultimately going to make software obsolete. Essentially, people will be able to go into ChatGPT or some other AI software and create their own software and basically put the major software providers out of business overnight. Okay. Secondly, the other macro picture that's out there, if you've been reading the Wall Street, is kind of around Blue Owl. Blue Owl is kind of now becoming the poster child for private credit, direct lending, whatever you want to refer to it as. And really it stems from the fact that late last year, early this year, they had a failed acquisition of a private BDC that they managed. They wanted to roll it into their public BDC, and ultimately it wasn't a great deal for either investor party, and so they backed off and said, we're not going to do it. So as we looked at it, we've spent a lot of time talking, reading with managers and the like, and ultimately, the things that we saw out there first is that software. Okay, is it possible that AI could replace it over time? Sure, but as we all know, the switching costs for software are real, whether they're explicit or implicit. Moving from a software that a firm has adopted, once it's in there, it tends to stay there for a long period of time because it's just a pain in the butt to transition. So that's one. Secondly, Blue Owl. If we talk about the Blue Owl situation, Blue Owl read the market. They said, okay, investors and the press hate that we have this segment of very sensitive AI, software exposures. And, how did they mitigate it? Well, they went out to the market and they got bids from numerous parties. And within a month, they sold $1.4 billion of this exposure off of their books. They sold it to 4 distinct parties who all came in at various marks, but ultimately they agreed at a 99.7% or cents on the dollar mark, which you say, well, why didn't they get 100 cents on the dollar? Well, that was par. So essentially the mark on the book was 99.7. So they basically sold it at where the book was at. So we look at this, and you and I have had this conversation, is that this was a validation standard for what's happening in the industry. Everybody's concerned about these assets, but in reality, like Blue Owl went out and sold 1.4 billion, excuse me, it's a lot, $1.4 billion of these assets to third parties. So they took that money, they returned 30% to the fund that was having this problem of converting from the private to the public BDC, and essentially have created a orderly wind down of the fund, which is what they've been trying to do. Secondly, we've also been looking at the public markets or comps, and these are what we would look at as the levered loan index. These are the publicly traded loans that look and feel like private loans, but have public CUSIPs. And what we've seen, the price volatility there hasn't been all that great. In the first part of this year, it's down less than 1%. We would expect some volatility given the negative headlines, but really it's been kind of a nothing burger so far. I think if anything, what people haven't been talking about and the Wall Street and others haven't been jumping on is that all of these stories are actually creating a better environment for future originations in these loans. And so that's kind of the macro picture. What I would love to hear from you is much more kind of granular, the micro picture on, what we're hearing from managers, what we're hearing in the sector, the risk that they perceive, and potentially how they're trying to mitigate it.
Yeah, absolutely. I think, the short answer is that these high-quality managers have been underwriting AI disruption for years. I think the longer answer is that, the old adage applies, which is everyone is a genius in a bull market. And we've had a good run in credit markets for a little while now. But credit markets are ultimately cyclical. And so we should expect to see some tick up in defaults at some point. And when that happens, our expectation is for dispersion across managers. We're going to see high quality managers start to differentiate themselves from the lower quality managers. The managers that have relaxed their underwriting standards, there's going to be some managers that, while they are high quality in a certain area, have kind of expanded their scope, widened their aperture, and reached on a few different types of deals. There's also a lot of tourists in the space, managers that are excellent investors in private equity or real estate or public credit, thinking, hey, we can jump into the private credit market. And I think you're going to see some of the issues show up in those types of managers as well who don't have the experience. The managers we're looking for are the ones that have very rigorous processes. They're insisting on covenants throughout the entire book. They have high quality monitoring systems to track the collateral and make sure that the quality is still there, dedicated workout teams. And what we're also looking for is a track record through multiple credit cycles. So 08.com, 20, 30 years of running the same strategy of lending capital in a specific area that they are truly experts in. And I think, in the case of elevated defaults, these higher quality managers are able to recover much higher values from their loans. And, for some of these managers, if they've done their underwriting correctly, they're paying attention to the collateral, even in the case of defaults, they're getting almost 100% of the capital back. So for every dollar of capital that they put into a loan that ultimately defaults, they're still getting $1 back. And that's really, the type of manager that we're looking for. And I think we're going to see that dispersion play out should defaults kind of continue to tick up.
Great. Yeah, I think there's more to be written on this story for sure, but it feels like, the work that we continue to do is additive to our client portfolios, which I'm excited about. So all great points. I think the second question that we always get, and now that we're kind of wrapping up the year and we're starting 2026, our clients are always asking, what is the IC working on, the investment committee? We go back into our offices, we've got closed doors most of the time, and we're doing a lot of research. I think it would be great for us to just kind of explore what we're working on, what's top of mind, and what people could potentially see in the next 12 to 18 months coming from us. So
Yeah.
What are you working on?
Yeah, absolutely. Look, it's a pretty exciting time to be investing in this space. I think capital markets have woken up to the value that high net worth and private capital provides within a capital solution. And so you're seeing a lot of managers that have long track records, phenomenal investment teams, but they've really only done so in the institutional space. And they're now kind of coming downstream and saying, hey, what can we do working with you guys? And so, there's a lot of great managers in, real estate credit. There's some agriculture and other kind of critical industries that we're seeing good opportunities in, structured solutions, secondaries across private equity. A whole host of good opportunities with good managers. The rub here is that every type of capital pool is unique. It has different structural requirements and different preferences. And so you have these managers with long track records, they're excellent investors, but they aren't sure how to come access this channel. And, I see that friction as an opportunity. And so that's where I've been spending a lot of my time, is working with these managers to craft an offering that makes the most sense for our specific clients, as opposed to a broker-dealer channel, maybe a large bank platform, or some of the more retail-y offers. And the benefits are twofold. Number one, I have an opportunity to influence some of these structures so that they work best for our clients. But number two, by doing so, there's often the opportunity to provide seed economics to these new offerings. And the benefit of these seed economics is basically we provide funding to a nascent structure, and the economics are significantly improved, whether it's a massive fee cut, whether it's sharing in the GP revenue. These are very accretive economics that we're able to develop. And this is where MIB and our other feeder funds come into play, because we can move quickly, we can move with scale, we can provide certainty of capital. And managers need that in order to get these funds off the ground. And in return, we can pass on pretty significant economic benefits to our clients, including the two of us who are investors in these very funds. So it's an exciting time, and yeah, I'm
Awesome.
looking forward to it.
That's great.
What about you? What kind of big picture stuff are you working on that the clients may or may not see?
Yeah, well, to start with, everything that you're working on will make me look really smart. So maybe I don't have to do anything, but clearly I come in every day and spend a lot of time thinking about how we can add value for clients. And from my perspective, you're going to be very much in the weeds with investments and the actual managers. Me, I'm going to be thinking about how can we come up with new structures for our families. And so the first thing you mentioned, MIB, Maslow Income Bridge. For those of you that don't know, that is our first feeder vehicle. It's a vehicle that basically will allow us to pool assets, go and invest in a multitude of strategies. And so it's going to be income oriented, as the name would imply, Maslow Income Bridge. But currently, that structure is only available to qualified purchasers. So that's $5 million or greater of investable assets. We are, at my level, we're trying to explore the possibility of converting that into a fund that will allow for accredited investors. And so you say, hey, that should be easy to do. It's not. There's a lot of complexities to it. It's actually registering with the SEC. We're already registered with the SEC as an RIA, but now we'd have to register this vehicle. Potentially, we'd have to take on an external board who would oversee it, external auditors, and the whole bit, which, again, these are controls that are important, and so we don't want to sidestep this. We don't want to do this incorrectly. So it will be a process, but I think if we can make that happen, now we will have a vehicle that we can offer to virtually every single family that is a client of Maslow. So that's for one. The second is, now that we've had success with MIB, we want to potentially think about what's the next iteration. And so we're talking about creating an accredited sleeve for MIB, but now what's the next asset class? Whether it's growth, which would potentially be a lot of private equity, other things that are higher growers to like special situations, to a hybrid fund, which might be more real assets, real estate, infrastructure. We're thinking about that. And then what's also the structure of those funds? So MIB is an evergreen fund, so investors can continuously add. It's always open. Potentially these other structures might need to be what are referred to as closed end, where we have vintage years. Maybe we have it open for 2 years and then it closes and then we start the next vintage. Those are the things that I want to start thinking about from a high level perspective, because now that we see the success of what's happening with MIB, like, we don't want to stop that train, because now there's so many benefits. As you've mentioned, we can help with the structuring of the underlying funds. We can get fee advantages. We can be much more tactical in our investment decision, which ultimately means, like, we're not timing markets, but we can find opportunities and we can execute very quickly. And so that's what I want to spend my time on. And I think if both of us are successful over the next 12 to 18 months, I think we're going to add a ton of value for clients, my personal opinion.
Yeah, I think it's certainly a compelling vision, and I'm looking forward to kind of building that out and executing on that idea. Well, that does it for another edition of Barside Chat. I'm Isaac Thompson, along with our CIO, Matt Chkimiak, and thanks for stopping by. We'll see you next time.